Welcome back to the Teaching Tax Flow podcast, everybody. Today, episode 105, we are kicking off part one of two of what we're calling our White House Walkthroughs. So as you can imagine, this has to do with the upcoming presidential election 2024. And this episode specifically, we are going to look at candidate Kamala Harris. But before we do that, let's take a brief moment and thank our episode sponsor.
This podcast is sponsored by The Mortgage Shop. Are you looking to qualify for an investment credit loan without jumping through hoops? That's easy. They have loans with LTV up to 89.99%. Exploring their products and discovering how they can work for you is simple. Just visit mortgage.shop or call 865-325-2566 and tell them TTF sent you.
You probably read it in the title, read in the description. We're going to dive into politics a little bit. So kind of uncharted territory, but here's the good news. We're not going to give you any opinions. It's all about facts. And this one and the next one, we're actually going to call it our White House Walkthroughs. So we're kind of pulling that from the archives, and we're going to talk about our candidates that we have right now. So we have Harris and Trump. On this episode specifically, Chris and I are going to go through some of the information that we have, factual information that's out there on both candidates, but we're going to look at Harris to get us started. So, Chris, Picciurro, welcome back, sir. You ready for this one?
Yes, John. I'm just going to come out with it. Oh, Sparty.
Oh, she's getting spicy.
I'm going to reveal right before we start, John, my vote for this election.
Okay.
You might be surprised. Sparty's surprised here. I hope Cooper's ready. If my vote goes through, we'll have our first female president in United States history. I'm going to write in Sparty and Cooper as
all right,
our candidates, right?
We're taking it.
On the K9 party.
You know what? I like it. I like it. And then, going back episodes too, we were talking about our 1099s and, the joke of, well, not the joke, some people asking, well, can I, write off expenses for my dog? So maybe if that happens, the 1099 K9 or the K, whatever it was, might actually come into play. So, hey, you know what? They got my vote too. I'm behind it. Love to see
like
the campaigns though. But anyways, so let's dive into this a little bit. So, I mean, these topics, I mean, there's no hiding behind it, right? People are going to be like, oh my gosh, these guys are going down a rabbit hole. This is going to be a disaster. But again, we're not going to give any opinions. This is all facts. This is all information that's been put out there by these candidates, specifically vetted information on both sides of the fence. And we're going to talk about it a little bit. So to kind of lay the groundwork for this, Chris, I know we talked a little bit, obviously, about doing this and how we were going to structure these. So we're going to run through a lot of the same, we'll call them focus areas, right, proposed by each candidate. But we're going to do, as I mentioned, this show on Harris, next one on Trump. Again, no specific order. We're just going down the list. What we'll just say is D in the alphabet comes before R. So we'll go, Democrat for Republican. There we go. We're following the alphabetical order of the party.
I think it'd be proper to go, incumbent first, even though Vice President Harris is not the president at this point. And ladies first, John. It's kind of like in pickleball. We had to throw it out there. When I'm playing with a female, I always like to give them the opportunity to serve the ball first.
Ooh, I like it. Okay. So let's dive into this, specifically looking at, why don't we just look at business tax? And again, these topics are, as they relate to taxes, we're not going to go off in the left field and talk about all this other stuff that's out there. You can do that on your own time for anybody that's watching or listening. But let's use that as the kickoff. So, Chris, I'll kind of let you drive the ship here for a little bit, and let's talk about what Harris has put out there regarding any business tax proposals.
Right. So before we get started, we want to talk through an awesome resource called Tax Foundation. It is a bipartisan, it's just an independent nonprofit that puts all this information together. They do an analysis on tax plans, and they're a great resource for this. So we're going to talk through what we know now. Obviously, things could change, and what somebody runs on doesn't necessarily mean that's what's going to get passed. But we want to walk through the tax part of this election, as you said. And with Vice President Harris, let's start with just business taxes in general. Due to the Tax Cuts and Jobs Act of 2017, The corporate tax rate, that's for C corporations, was dropped to 21%. And that was a significant drop. According to the Tax Foundation, so everything we talk about is according to the Tax Foundation, taxfoundation.org. If you want to check up on what we've been researching, she has indicated that she's going to increase the corporate tax rate to 28%. So that's a 7% increase, so about a 33% increase for C corporations. Now, one of the disadvantages of a C corporation is that they are going to be subject to double taxation in general. So the corporation pays a tax on its net profit, and then it pays dividends to the shareholders. Well, those dividends are not deductible by the corporation. That means there's a double tax. So ultimately, all larger publicly traded companies are C corps. A lot of small businesses are C corps as well. So, but what she has indicated is that 21% tax rate for C corporations, due to the Tax Cuts and Jobs Act, she's proposing that it goes up to 28%. So that's a pretty significant increase.
Absolutely. And Chris, thank you too for describing that too about C corps, how that falls into what's considered as double taxation too, because I think it's really important to obviously people understand that part of it. But yes, thank you.
Oh, my pleasure. So yeah, so that we'll see how that shakes down. And the corporate tax rates have been up to 35% before. There's different estimated changes to the GDP based on different corporate tax rates are part of Tax Foundation. But anyway, so increasing corporate tax rate to 28% is one of the proposals at this point. And then we start looking at capital gains and dividends tax. Now we know under the Tax Cuts and Jobs Act that long-term capital gains and qualified dividends. So what a qualified dividend is that's a dividend you receive from a mutual fund, stock, or security that you've owned for at least 1 year. Those dividends and those long-term capital gains, any capital asset that you own for 1 year or longer. Those right now are taxed in general at 15% for the vast majority of people, although that for some people they're taxed at 0%, and for the very small high income earners, it's taxed at 20%. But then Vice President Harris is proposing that to increase the top rate on long-term capital gains to 28%, up from 20%. For taxable income above $1 million. So if you have an income over $1 million, instead of either a 15 or 20% rate, you'd pay tax at a 28% rate for long-term capital gains. Now, again, we're talking about the vast majority of taxpayers are not over $1 million of income. However, that would be a significant change as well. So that's what's getting proposed at this point. And I don't really know, and it's tough because sometimes you really don't know what for taxable income of $1 million or more. Does that include the capital gain? Is that outside of the capital gain? But anyway, so increase in long-term capital gain rates, and then there's something pesky. This has been around for a long time. Something called NIT. Sounds like a bug, doesn't it?
It does, yeah. It's like NIT, NAT. Don't like them.
Yeah, NIT stands for Net Investment Income Tax. And ultimately what that is that it's an additional 3.8% tax for people with incomes, married, filing joint, in general, more than $250,000. What the NIT tax is, it's a supplemental Medicare surtax. So when so it's just an additional tax for higher income earners. That's what NIT is, NIIT. Right now, married filing joint, you start paying NIT at $250,000 or more. Single head household, $200,000. Married separately, $1.25. There are several different types of income that's subject to NIT. So if you're in that, and you probably don't even You may have not even heard. You may be paying this and not even heard of it. If you're unsure if you've been paying it and you want to look on your tax return, look on Form 8960. That's where the net investment income tax is calculated. So that's a 3.8% tax. Now, for some of you listening, I'm sure you heard our Leveraged Charitable Giving podcast episode. So let's say you have a high W-2. You realize that once you get to a certain W-2, certain level of W-2 wages, first your Social Security tax withholding stops if you're over the that threshold. But secondly, the net investment income tax withholding is automatically taken out. So you might not even feel, quote unquote, that you're paying this, but you are. And again, it's a surtax. Well, what Vice President Harris has proposed is that 3.8% tax goes up to 5% on any income over $400,000. So if you are over $400,000 of income, on top of your federal income tax, the net investment income tax would go from 3.8 to 5%. So an additional 1.125% approximately. And that's what I think that everyone should be listening to both candidates here when you dive into this. Or even on the local level, state level. Obviously, we can't get in every state, but I've seen many states and federal candidates say, we are not increasing your federal income tax or your state income tax. That might be true, but there might be other little phase outs and credits that you're losing and these additional taxes that you're paying that you don't feel that you're getting hit with. So you've got to, that's why, John, we talk about it all the time in teaching tax flows. Your marginal tax rate is more important than your tax bracket. So if you're over that $400,000, you're already paying some type of NIT. And that would, under her proposal, that would go up.
Absolutely. Yeah, that's one that you mentioned too. A lot of people probably don't even realize that that's on there, but it gives you a little takeaway of this. From this, if anything, go see what that looks like for you.
That is true. That's true. So that kind of gives you an idea on the capital gains and qualified dividends. So let's go on the business tax. Now, I just mentioned credits, deductions, and exemptions. These are kind of those hidden taxes, almost like a John, like let's say you go out to. Here's a great example. This is my best analogy. You go on a Ticketmaster, one of these ticket exchanges, and you buy a ticket for X amount of dollars, but the cost is almost double because of service charges and quote unquote convenience fees and all that baloney, right? So when we talk about like tax credits, deductions, and exemptions, think about service charges, and those type of things that take, hey, I'm paying $100 for this ticket. Why is it $156 when I go to cash out? Rental cars are another example of that. So what she's proposing on credits, deductions, and exemptions. First thing is that she wants to exempt tip income from taxation. So as of right now, that any income you receive is subject to federal tax, and you should be reporting it. Now, we know that nowadays, though, John, I think most tips are done electronically. I mean, when we were growing up, pretty much all the tips were in cash, and the government had a tough way to track those. But yeah, she's proposing that tip income is exempt from taxation, and that's not for people in that situation. Most of those, most taxpayers that rely heavily on tip income, aren't in the highest marginal tax rates, so that could help them. And it would help. I mean, I guess it would help.
With this too, I literally just thought of this, which is kind of related, but kind of not, but also not really funny is, and I don't know the other candidates' proposal on this at all, but it's almost like now where I believe QuickBooks Online and a couple other invoicing softwares for professional services, etc. Now you can add an option in there for tip. If something like that were to change, it would be interesting how many people, instead of sending an invoice for $5,000, maybe send an invoice for $100 and ask for a $9,500 tip. So
correct.
I'm sure it poses all kinds of challenges, but to your point, right? The majority of them, it's a different situation.
Right. There's a ton of these proposals that I would imagine if just and I hate to even pontificate because these episodes are about what's being proposed, but I would imagine that if tip income was exempt from taxation, there would be some type of threshold to it. So,
right.
So the other thing, so back to credits, deductions, and exemptions. She does want to expand the child tax credit to $6,000 for children under 1 year old, $3,600 for children 2 to 5, and then $3,000 for older children. So that would be an expansion of the child tax credit. And it's interesting. It's an interesting model because ultimately the credit decreases as the kids get older, right? And you've got a young child. We know that first year can be expensive. Again, so expanding the child tax credit, but not only expanding it, but she's thinking what she's proposing is it's higher early on. Now, that being said, remember that child tax credits can easily phase out, right? So the child tax credit can phase out based on income, which we'll kind of chat about that in a couple minutes. But
and maybe the thought behind that is, right, if you have a 1-year-old at home, raising that to $6,000 would help you stock the mini bar, especially if you're a first-time parent.
That's true, John, but guess what could happen then? You might have another child soon. But anyway.
Very true, very true. So yeah, then it just starts all over again. But yeah, no, I see it. And this is something that has never really been done, right? Like they've never really had a scale like this.
Well, it did. Yeah, I mean, it was $2,000 per child, but under the American Rescue Plan Act in 2021, which we know was a result of the pandemic, there is a little bit of there was a temporarily a higher credit for younger kids, and there is a phase of, I think it's 16 and younger.
Gotcha.
And there's also phase outs based on income, so that's another thing to consider. So that would be the maximum child tax credit. So another proposal is she wants to expand the earned income credit for people for taxpayers that do not have children. So what the earned income credit is it's a credit focused for lower income earning taxpayers. And depending on your income and how many dependents you have, you can get a credit from the IRS. So what that means is that, so why is this in play? The earned income credit came up, it's my understanding I know it came about a long time ago, but it was a way to encourage lower income households to actually work instead of not work and maybe take advantage of some welfare programs. And so that the IRS said, or the Congress said, look, we want to reward you from working. So if you go work and make $20,000 a year and you have one child, we're going to give you an extra $3,000 in your pocket, a refundable credit. So as of right now, if you do not have any children and you're single, your earned income credit maximum would be $632, and that would assuming that you have about $18,600 worth of income. So there's a whole earned income credit table based on having 0 dependents, 1, 2, or 3. The maximum earned income credit for someone with 3 or more qualifying children is $7,800, and for a married couple, they can make up to about $66,000. $66,000 is the I think that's the maximum amount you can make to get the earned income credit. So it works like a bell curve, where it goes, it starts off little and then you hit that maximum and then goes down. Now, there has been a lot of fraud in the earned income credit world and a lot of crackdown and enforcement by the IRS. Because quite frankly, there might be someone that is in that range that qualifies for an earned income credit, and someone might not. And then it comes down to, are you claiming the proper children? I mean, there's been a lot of bad stuff happening with that. But for the people that this earned income credit that is intended for, it is very, very helpful to them. So she wants to expand their earned income credit for people that don't claim children. So what that's going to be, we don't know, but it is something that is out there. So another credit is the premium tax credit. This is really tricky and very confusing. But what the premium tax credit is that has to do with the back when we go back to Obamacare and in buying health insurance in the what everyone calls the marketplace, based on your income, that your health insurance premiums could be subsidized by the government. And let's say that your health insurance is $600 a month, and you told the exchange that you're going to, or the marketplace, that you're going to make 30 grand, but you really made 20 grand, then you get a premium tax credit, meaning you get the subsidy you should have gotten if you made 20 grand. So again, that could be a whole episode there. The point is, one of the things she's proposing is that the expansion of the premium tax credits. She's also looking to expand housing tax credits, low-income housing tax credits, credits for new home buyers, and a credit for construction of starter homes. Now, I don't know what would be defined as a starter home. That's where it gets kind of, tricky. Although, there was in some of the articles we were reading that there was up to a $25,000 tax credit for first-time home buyers over 4 years. So let's say you haven't purchased. The theme is this: if you're not a homeowner right now and you buy your first home, you might have owned a home. So there's a first-time home buyers credit back in the 2010s, 2011 time frame when we were trying to spur the economy, get more home ownership. If you don't own a home, in other words, with the IRS first-time home buyer, it doesn't mean you've never owned a home. There's always a look-back period. So it looks like, no pun intended, that what she's proposing is there's a 4-year look-back period. So if you've been a renter or not a homeowner, had different living arrangements for at least 4 years, then you could potentially be a first-time home buyer and potentially get a tax credit for that. Now, there typically is going to be some significant income phase-outs. We don't know what that is yet. But that's what she has. She's proposed.
I didn't know that about the look back, and Chris, I think we would be doing ourselves a disservice if we didn't bring California somehow into this mix, right? So when they talk about starter homes, like anybody that's ever looked up in the main metro areas, especially in California, right? A starter home there is like a mini mansion here in the Midwest. So it's yeah.
Well, and that's a great point, though, John. And that's why I will always say there's no such thing as an easy tax return, because is Congress going to say, okay, well, we've been tasked to create this law. Are they going to make a cost of living adjustment for what they consider a starter home? Now, we're going to have tons more content once the election is done. And, this is about tax planning and strategy and legally and ethically reducing the tax you pay in your lifetime. So who knows? Like I could just, so we're going to have a lot of content on that, but I'm just thinking if there's an income threshold of $60,000 and I have a client that's self-employed, that is makes 70 grand a year, we might form a corporation for a couple of years, make sure that they stay under the income limit, pay a little bit of a corporate tax just so they can get that housing credit. So they might be subject to a little double taxation. That's where tax planning comes in. And John, I'm always an advocate of tax planning. I think tax planning is not just for high income and high net worth taxpayers. It's for anyone.
Absolutely.
So there is there is some sentiment around clawing back deductions for depreciation and interest on certain rental construction investments. Don't have a ton of information on the details of that, although that would mean that you could potentially not get as many deductions if you're investing in rental properties. Potentially, I don't want to assume anything. It's just a
right.
It's just a thought. And then increase so when you have a startup business, you can get an immediate deduction. So deduction of up to $5,000. So John, let's say you decided, remember you were crocheting a few episodes ago, right?
Oh, yeah.
You decide to get out of that, and you're going to get back to your roots of hockey, and you're going to start a hockey training academy.
Ooh, that would be interesting. I haven't been on skates in a while, so
it would
be better off crocheting.
50 grand or 100 grand. The first $5,000 is deductible. The remaining $95,000 you have to what's called capitalize and amortize over time. Well, it seems like Vice President Harris is looking to expand that startup deduction from $5,000 to $50,000. We don't have a lot on estate and wealth tax. However, if one of the reasons I think that's the case is that if Vice President Harris wins, she'll be in office when the Tax Cuts and Jobs Act expires, and all of those higher estate tax thresholds of $13 million a person would be gone. I don't have anything on estate and tax, but it's something we really need to be aware of, and we're going to focus on once the results of the election, because ultimately she might not have to propose any type of estate tax exemption decrease if she was to win, because it's automatically built into the expiration of the Tax Cuts and Jobs Act.
Makes sense.
And then the other things that she has mentioned over the last few months of note would be the 1031 exchanges. So 1031 exchanges, it was a like-kind exchange. If you don't know what it is, don't worry. We've got a podcast episode. We have an amazing guest as well. And what a 1031 exchange is that if you sell a real estate investment and reinvest it into another real estate investment without taking any cash into your pocket, you could defer the gain and you could have a new asset. And at that point, you could defer as much gain as you want right now. Well, one of the proposals that she's mentioned is that the limit to the 1031 exchange of up is $500,000 a gain. So if you have $1 million gain, you can only defer $500,000 a gain, and you would have to pay tax on the other $5,000. So that would be $500,000. The limitation of the 1031 exchange would be a seismic change to the real estate industry, to say the least.
Because that I think we referred to it multiple times in that episode and other ones as it's almost like an REI, so real estate investors, it's almost like their secret weapon a little bit, which it's not getting to be such a secret. And I think I mentioned it on that one specific show you had referenced as well too, is, I've talked to some guys that might have 10, 15 properties that didn't even know it existed, where it's like, holy cow, be like, it's a very, very powerful tool. But again, go back, listen to the episode. We won't talk through that one.
Right. And there are some other things that she's thinking about doing. There are changes to the global intangible low taxed income. We call it GILTI in the business. There's some kind of needle in the haystack thing that most taxpayers will never run into. So we're gonna kind of focus on what we're talking about. The other thing, I'll mention a couple more things. We talked about that NIT, increasing the top individual income tax rate to 39.6% on income above $400,000 for single and $450,000 for married joint is something that's been proposed. Now that's really interesting because ultimately there used to be something called the marriage penalty from a tax perspective, in so fact that two individuals would be better off tax-wise being unmarried, and the marriage penalty got fixed. Well, if your income tax rate is at 40% basically for any incomes over $400,000 for a single person, but $450,000 for joint filers. John, let's say you've got two taxpayers that each make $300,000 and they're married. If they were to divorce, they would go from pretty much a 40% marginal tax rate significantly down. Again, can't let the tax tail wag the dog, and you can never put a price on love. But I'm just saying, things like that are going to happen. I do want to touch on one more thing that she did propose, because on the tax on long-term gains and qualified dividends, I said that max would be a little higher. Also, it's been talked about that that would be for that $1 million, anything over $1 million. There's also been talk about taxing unrealized capital gains at death. So again, we don't have anything really concrete on that, but we want to discuss that. And then limiting retirement account contributions for high income taxpayers with large IRAs has been something talked about. So the theme would be is for people that are in those high marginal tax rates, limiting the amount they could put into retirement, because we know that is a tax deferral and that gives them an immediate deduction. The theme I'm seeing here is this: one, a little bit high, well, not more, a significant slightly more taxes on the business and personal side. But here's the thing. We talked, John, about one of the 3 laws of tax planning, teaching tax laws, that tax laws are written to this isn't a law, but that tax agencies are an involuntary business partner. And as I look at some of these thresholds, what keeps popping out to me is that $400,000 number. And so what the proposals that Vice President Harris is throwing out are really targeting people over that $400,000 threshold of income, or households over that income. Some of the phase outs occur before then, some of them occur after, but that's kind of where we're at. And then to wrap up, the Tax Foundation does its own analysis. They do a detailed economic analysis of each candidate's proposals, and they walk through each one. How much is the change in gross domestic product? How much the change in wages? And what's the change in full-time equivalent jobs, up or down? Which is very interesting. So, according to the Tax Foundation, if all of Vice President Harris's proposals were to be enacted, which we know wouldn't happen, we would see a decrease in full-time job equivalents of 786,000 jobs. Again, this is what the Tax Foundation's calculated. And John, we'll put a link to this in the show notes so you guys listening can check it out. And I want to reiterate one more time. We are just focusing on the tax part of this election, right? There are a lot of other considerations. And no matter what happens, there's always opportunity for tax planning and strategy. To wrap up, bringing it back to teaching tax flow, if tax rates do go up and a higher percentage of taxpayers are in a larger marginal tax rate, then we're going to probably focus on more red diagnosis tax planning strategies and more tax deferral, because you've heard me say it a million times. Right now, taxes are on sale, and we don't know how long that's going to last.
Absolutely. And Chris, too, I kind of reiterate a little bit, too, what you mentioned earlier on, and then just, again, to kind of lay it out to everybody. Next week's show, we're going to do the other candidate. So I know we're going to talk about that here relatively soon, just kind of split it up a little bit. So that'll release next week. But also, too, right, like these are just the proposals that are anticipated on being in place. So whether some go through, whether some don't, things will change. It's almost like putting together a puzzle, right? Like you can't make the entire puzzle in 5 minutes. You might get a portion of it done, but then when you get back to it, somebody might have spilled it over. Half the pieces are gone. You mix and match a little bit. So again, not to scare anybody if you are afraid of any of these changes, and we'll get into the other candidate as well as mentioned, but it's very unlikely that everything would go through. Chris, exactly what you said. So I look forward to the next one we do here on the podcast here coming up on Trump's proposals as well. Provide all the information provided by the Tax Foundation. And as always, we will see everybody back here again next week, roughly the same time. Semi-more related topic this time, but we'll see everybody soon. Thank you for joining us here on the Teaching Tax Flow podcast.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.